Good afternoon, everyone, and welcome to the GASB 68 overview. This is part one of a GASB webinar series that Loggers Chief and Financial Officer Melissa Rackers is going to be conducting. The second one is going to be a week from today on September 29th at 2 p.m. I'm guessing a lot of you are already registered for that webinar, but we do still have some openings available. So if you'd like to go ahead and get on our website, go to our webinars page, and register for that webinar as well. We would highly encourage that. We'll take care of a few housekeeping items before we get started. First of all, my name is Jeff Kemker. I'm the Manager of Member Services for Loggers, and I'm going to be a panelist today, and basically my job is to introduce Melissa Rackers, and then I will be monitoring all the questions that you have. So we highly encourage questions, and the best way to get your questions to us is if you look at your GoToWebinar toolbox on the right hand side of your screen. You should have something on the right hand side of your screen unless you moved it somewhere else. There is a tab called Questions, and if you click on the little plus sign to the left of where it says Questions, it will open up a text box. So feel free throughout this webinar to type your questions in that text box and send to me. I will see those as they come in, and then at the end of the webinar, when Melissa is through with her slides, we will go through all those questions. I will ask them, Melissa will answer them, that sort of thing. So we do highly encourage questions, and those are right there. We also have a handout if you'd like a copy of the slides. You should be able to pull that off of the GoToWebinar interface as well. There's a tab called Handouts. If you open that up, there's a PDF there that you can open up and save. It is also located on our website. We have a GASB page on our website. If you go to our main employer page or employer tab on mologgers.org, we have a whole page specifically dedicated to GASB, and a PDF of this presentation is there as well. So with all that being said, I will go ahead and turn it over to Melissa Rackers, and then like I said, please type your questions in the text box and we will answer those at the end. Melissa, the floor is yours.
Thank you, Jeff. This is Melissa Rackers, the CFO here at Loggers. Jeff did leave out one very important job that he has, and that's to help me if I get myself kicked off this webinar. You guys are attending my first webinar, so hopefully I can handle all the technical aspects of this and not get myself kicked off. So thank you, Jeff, and thanks for all of you for attending today. Hopefully this will be good information for you guys, as a lot of you June 30 reporters are working on your financial statements right now. So this webinar is just going to be an overview of GASB 68, and for any of you who have heard me speak before at GFOA or Missouri Society of CPA or even at the Loggers annual meeting, this will be pretty similar to what I've gone through before. So let's get started. So GASB 68 is accounting and financial reporting for pensions, and it's applicable to any state and local government employees provided a pension through a pension plan, so any of Loggers' participating employers. And it does replace GASB 27. I know a lot of you have been sending in your request for your GASB 28 note disclosures. Well, those have been superseded by GASB 68, which is why you haven't received them. So it is effective for fiscal years beginning after June of 2014, so starting with these June 30, 2015 fiscal year ends. It does somewhat divorce funding from accounting. In the past, what you've been reporting in your notes into your financial statements have been very similar to how we're asking you to fund your plan. Well, GASB 68 kind of breaks those two, apart. GASB's purpose for this is aiming for more transparency. So, I mean, I know everyone has their own opinions on that, but that is GASB's goal here, is just for more transparency among multiple pension plans. It does require the net pension liability or asset to be reported on your financial statements. And this, for a lot of our employers, will likely have a significant impact to your financial statements. This is a just a little chart that I put together comparing GASB 27 and GASB 68. You can see for basically the balance sheet, the only thing you have been reporting under GASB 27 is if you have a net pension obligation or a net pension asset. So basically, if you've made contributions either above or below what the plan is asking you to contribute, your actuarially determined contributions. Now you will be reporting either a pension liability or a pension asset. On the income statement, you've been reporting a pension expense, which is essentially the amount of contributions you've been remitting to loggers during your fiscal year end. This will be a very different calculation, and we'll talk a little bit about that in a couple of slides. Note disclosures, you've been giving a plan description and some membership data and your benefits and contribution information. That will continue, but it'll be a little bit more expanded. Under the required supplementary information, or the RSI, you've consistently been giving 3-year schedule of funding progress. Well, that is going away, and you're going to be reporting information on your net pension liability, changes in the liability, and your employer contributions, and they are going to 10-year schedules. And here's a chart just kind of showing the difference between funding versus what the accounting changes are going to be under GASB 68. For funding purposes, the discount rate has been the long-term expected return that is set by loggers, which is currently 7.25%. Under GASB, you start with the long-term assumed rate only to the extent that your assets are projected to cover your liabilities. After that point, GASB is, requiring the use of a municipal bond rate and then blending those two rates together. So that's quite a bit different than what's used for funding. The asset valuation for funding, loggers has been using a 5-year smooth asset value, and for GASB it is requiring the use of the market value of assets. For amortization, for funding, plans have been allowed to be considerably flexible. Loggers is moving to a closed 20-year. GASB is using a much shorter period, and we'll go into that in a little bit later, how they're asking for the amortization period to be determined. The actuarial cost method, for funding purposes, there are about 6 different methods that are allowed to be used. GASB is requiring the use of the entry age normal, which is what loggers already uses, so there's no big change there. So we're going to get into some of the new terminology and the calculation. So there is definitely all new terms being used with GASB 68. So I try to, where appropriate, kind of tell you what the funding equivalent is to this terminology. So starting with the net pension liability. So this is basically, the counterpart to funding of the unfunded actuarial accrued liability. And it is equal to the total pension liability minus the fiduciary net position. And the fiduciary net position, like we said, is the fair market value of assets. The net pension liability will be reported on the balance sheet item in your employer financial statements. And again, this is likely to be a pretty volatile number, mostly because of the use of market value of assets, where we don't see that on the funding side because we're smoothing assets. The total pension liability is your counterpart to your actuarial accrued liability. And it's the liability for projected benefits attributable to past service, including COLAs. And again, it's determined using the entry age normal cost method and the single discount rate expressed as a level percent of payroll. So really the only thing different here versus what you see for funding purposes is the single discount rate. So a little bit more information on the single discount rate. Again, the logger's assumed rate of return is 7.25, and that is something that loggers looks at about every 5 years, and we're in the process of looking at right now to see if we believe that's still reasonable. So you use that rate to the extent your projected assets are sufficient to pay your future benefits. To the extent your assets are not projected to pay your future benefits, GASB is requiring the use of a 20-year tax-exempt municipal bond rate. And I believe Currently, that's around 3 or 4%, so considerably lower than the assumed rate of return. So this lowers your single discount rate, which in turn increases your liability. For the most part, loggers employers are going to be able to use the assumed rate of return of 7.25. This is not the case for all employers, and as most of you are probably aware, each year, as part of your actuarial evaluation, we determine your required contribution rate. Well, that contribution rate per our state statute is only allowed to be increased by no more than 1% each year. So we do have a handful of employers who have what we call an uncapped rate. Their rate was calculated to increase more than 1%, but because of our statute, we're limiting it for funding purposes. So depending on the variances between the rate you're using to make your contributions and your uncapped rate, you may fall in a situation where you're using the single blended discount rate. But that won't be the norm for loggers employers. Because we do require you to make your contributions, we have very few employers that are going to fall into that situation. So moving on to the pension expense. The pension expense under GASB 68 will essentially be the change in the net pension liability from year to year. Some of these changes are treated as deferred outflows of resources or assets, or deferred inflows of resources, which are liabilities. And some changes are also immediately recognized. I think the deferred inflows and outflows are probably the most confusing part of the new GASB statements. So talking a little bit about the deferred inflows and outflows. These arise from basically three different areas. Changes in the fiduciary net position due to differences in projected versus actual investment earnings, or changes in the total pension liability due to changes in assumptions, or differences between the assumed and actual experience. So we all know actuaries make all these assumptions when they're trying to calculate the liability, but that's not what actually happens from year to year. So a lot of these deferred inflows and outflows are changes versus what they assumed and what truly happened. So any changes in the fiduciary net position due to investment earnings are recognized over a closed 5-year period, and that is the same for all employers and for all plans. Any changes in the total pension liability due to changes in assumptions or differences in experience are recognized over a closed period reflecting average remaining service life of all members. So this will be calculated individually for each of the loggers' employers, and it includes actives, inactives, and retirees. So if you think about the average remaining service life of a retiree, it's 0. So this dramatically reduces the amortization period. I'll tell you, in some of the mock groups that we've run, it's around 4 or 5 years, so considerably shorter than the 20-year that we're using for funding purposes. Some liabilities will also be reported immediately as an expense, and these are due to changes in your benefit programs. So any liability resulting from a benefit change will be expensed immediately. So that's something to remember when your city or county is looking at making a benefit change. This could be a significant number that's being reported as an expense in that 1 year you make the change. So I'm not saying that's a reason not to make benefit changes. I'm just saying it's another thing you need to think about when you are making a benefit change. So all of these calculations are basically determined as of what GASB is calling a measurement date. So this date can be no earlier than the employer's prior fiscal year end. Loggers spent a lot of time thinking about what should our measurement date be, because all of our employers have different fiscal year ends. Loggers has used June 30 as the measurement date. Primarily it's because that's the loggers plan year. So that's when our audit is being done. So that's, Williams Keepers is our audit firm, and they're here and they're auditing our assets, well, really everything for the financial statements, but we need an audited number for our market value of assets to provide our actuaries to do these calculations. So that's kind of where the June 30 measurement date was chosen. The loggers' actuarial valuation date will remain the last day of February. There won't be any changes in the actuarial valuation process. So a little bit of valuation terminology, or just, the fact that we kind of have three separate dates going on. We have the financial statement date, which is the date the financial statements are prepared as of, which will vary by each employer because it's their fiscal year end. We have the measurement date, so the date the pension liability is measured as of, which, like I said in the previous slide, for loggers is June 30. But each individual plan was allowed to select their own date. Loggers just chose June 30. And the actuarial valuation date, the date the actuarial valuation is performed as of. And again, loggers will remain at the end of February. Some of the requirements there for GASB was just making sure plans are receiving regular actuarial valuations, which loggers does since we do them annually. Moving on to the note disclosures. Again, not drastically different in what you're providing for plan benefits or plan information and the benefits you're providing. They are also requiring disclosure of significant assumptions employed in the use of measuring the net pension liability, descriptions of benefit changes and changes in assumptions, disclosure of assumptions related to the discount rate. The disclosure of the net pension liability would be if a discount rate 1% higher or 1 percentage point lower had been used. Their goal here is they just basically want to show the volatility of the discount or of the net pension liability using different discount rates. The net pension liability at the beginning of the year changes during the year by cause. The balances of deferred inflows and outflows of resources, and the net amount of deferred inflows and outflows that will be recognized as pension expense, and the amount of deferred outflows that will reduce the pension liability for each year in the next 5 years. So they want to kind of see that breakdown of what your deferred inflows and outflows are going to be in the future. Again, those deferred inflows and outflows are going to make things a little bit more complicated. Your required supplementary information. These, like I said, are moving to 10-year schedules. They want to see the change in net pension liability by cause and the schedule of change in net pension liability and related ratios. Also want to see the actuarial determined contributions versus the actual contributions made, and then show them as a percentage of payroll. So with these being 10-year schedules, the first two you will build prospectively because they have to be, you had to be able to provide the information using the calculations set aside by GASB. So obviously we're not going to go back 10 years and recalculate all of this. We'll just build those prospectively. The schedule of contributions, they do ask that you show all 10 years if the information is available. Loggers does intend to provide the schedule of contributions for the past 10 years because we do have that information. One more thing on the RSI. The first two mentioned are prepared as of the measurement date. The schedule of contributions has to be prepared as of the employer's fiscal year end. That one kind of threw us for a loop because now we can't make that reporting part of the accounting schedules you're going to receive from the actuaries because they have to be done as of the fiscal year end. So that's something loggers will put together and report to you, to all of our employers as they reach their fiscal year end. So with all of this and these being major numbers, being reported on your financial statements as opposed to note disclosures, there's a lot of audit concerns because all of this information is going to be provided from loggers or the actuaries, and we're going to hand you this information that we're asking you to put in your financial statements, but what assurances do you and your auditors have regarding the accuracy of the data? So how will the employer obtain all necessary information to support their net pension liability, deferred inflows and outflows, and pension expense, and fiduciary net position? How will the employer auditor obtain sufficient audit evidence regarding these pension amounts? One of the other concerns is the plan financial statements do not give the participating employers everything they need. So what we mean by this is if you look at loggers' financial statements, the requirements set aside for GASB 67 for agent plans have drastically different reporting requirements than just 68 for those of you participating in loggers. For agent plans, we're not calculating this net pension liability at the plan level because it's being calculated at the employer level. So you can't look at loggers' financial statements and get the information you need to put in your financial statements. So that's a little bit confusing on the agent side. And how do the auditors verify completeness and accuracy of census data used in actuarial calculations? You know, the census data is something loggers provides the actuaries each year, but it's something the employers have been completely removed from. Well, you're going to start getting your census data, and your auditors are likely going to start wanting to look at what loggers is reporting it and comparing it to, say, your payroll records and things like that. So they're going to look at the things that you're reporting to loggers that we're turning into the actuaries to use in calculating these liabilities. So the AICPA issued 3 different white papers to help address some of these audit concerns related to GASB 67. The first one I have listed here is the white paper associated for agent plans. I did go ahead and list the 2 for cost sharing. They don't apply to loggers, but some of our employers do participate in multiple plans. So if you haven't seen these, this is the link to the 3 white papers that the AICPA issued. We also have a link on our website on the GASB page for the agent multiple employer white paper. So if you haven't taken a look at these, I strongly encourage that you do before your auditors come to start working on your financial statements and doing your audit. So the audit best practice issued by the AICPA sort of for agent plans broke it out into 2 separate parts. One for the total pension liability, the deferred inflows and outflows, and the pension expense, and the second part for the fiduciary net position. So the first requirement for best practice for the liability side is employer-specific actuarial evaluations, which is no problem because all of our employers do get their own actuarial evaluations. And they also ask that the plan auditor, so loggers auditor, Williams Keepers, does one of 2 things: issues a service organization controls report over census data maintained by the plan, or performs an examination engagement over selected management's assertions related to census data. I will tell you, loggers has chose to do option 1, the service organization controls report, or SOC 1 type 2 report. And that's something that we're working on right now and should have a report out by November. It also suggests that the employer support the actuarial assumptions and underlying census data, and that the employer auditor should evaluate the capabilities of the plan actuary and obtain an understanding of the work and evaluate appropriateness. So Gabriel Roeder Smith is the loggers actuary and has been since the inception of loggers. There is some information in the accounting schedules about GRS and this particular actuaries that work for loggers, and their bios are out also on the GRS website. So hopefully the auditors are able to obtain the information that they need regarding GRS from there. So moving on to the asset side, or the fiduciary net position, they've asked that the plan prepare a schedule of changes in fiduciary net position by employer and provide appropriate notes. So essentially what that is the plan's loggers income statement broke out to all of the almost 700 loggers employers, and that is something that we are preparing right now and do intend to provide. And then they asked the plan auditor give an opinion on this schedule through either the schedule as a whole combined with the SOC 1 Type 2 report, or on each individual employer column in the schedule. Loggers has chosen option 1 to include the asset controls as part of the SOC 1 report, and the auditors will issue an opinion on the whole. But the employer is responsible for determining accuracy. So basically looking at it and I guess telling if it looks reasonable. I mean, I don't know any other way to, for the employer to determine whether it's 100% accurate, but you can certainly, look at the data and determine reasonableness. And the employer auditor is responsible for determining sufficiency and appropriateness of audit evidence. So how does loggers intend to approach this? From the financial reporting side, you'll continue to get your actuarial evaluation prepared as of February with a roll forward to June 30th, which is the measurement date. We'll be providing GASB 68 accounting schedules, which we will distribute to all employers probably in late October, early November. This first year may be a little slow getting through the process the first time, but it'll get better, each year we go on. Employers will receive census data for their members, and this information actually is already available to all of our employers. It is posted to your employer web portal for those of you who use the portal. And you will also be receiving a schedule of contributions required in the RSI. And like I said, this is done as of the employer's fiscal year end. So if you have a June 30 or a July 31st fiscal year end, these schedules are also posted to your employer web portal. So as I mentioned before, from an auditing standpoint, Loggers is currently working on a SOC 1 Type 2 report. The time frame for this initial report is a little odd because if any of you are aware, the AICPA did not issue their white paper on agent plans until the very end of May in 2014. So in order to have done a white paper for the entire fiscal year end, the entire measurement period, which is July 1, 2014 through June 30, 2015, we would have had to have basically our report written in about a month's time and start testing. Well, that didn't happen. So we just chose for the initial year for the SOC report to be January 2015 through June. Going forward, the SOC report will cover the full year. It's just this initial year. We, given the late timing of the AICPA's white paper, we did opt to just do the shortened year. The SOC report should be issued each year shortly after the distribution of the GASB accounting schedules. And the schedule of changes in fiduciary net position will also be issued about the same time with the opinion on the schedule as a whole. So what is a SOC report? I'll keep this very high level. I'm glad Pam Hopkins, our compliance officer, internal audit, has taken the lead on the SOC report, so that's kind of kept me from having to deal with it too much. But it's a service organization controls report, and it basically lists high-level business control objectives and provides detailed support on the controls that are in place to mitigate any operational risk. And then shows the results of testing of these controls, which are being done by our compliance officer and also by Williams Keepers. And it also outlines controls that Loggers believes are in place at the employer level. So your employer controls or your user entity controls. So these are controls that the employer has on processes you have in place to help ensure Loggers' retirement plan information generated for your financials are reliable. So this is information, that you're providing on your employees' wages, when you enroll a new member, their date of birth and, their hire date and things like that, information that you initially provide to Loggers. So, we believe you have some controls in place in reporting that data to us. So you want to have these controls in place at the beginning of your fiscal year end. And you also want to discuss with your auditors what types of documentations or what types of additional testing they may want to see in regards to these controls. We have posted a document to the GASB page on the Loggers website that lists what we believe to be the user entity controls. So you may want to take a look at that and make sure your auditors are aware of them as well. So this is a little slide about what makes Loggers different. And I will tell you, this is definitely, while I said deferred inflows and outflows are the most confusing, I think this is the most challenging for Loggers. So as you all know, Loggers is an agent multiple employer plan. Each of our employers is allowed to pick their own level of benefits. They pay contributions based on their particular member group and their level of benefits. So we maintain individual reserve accounts for the members and for the employers. But what some of you may not be completely aware of is we pool our reserves to pay benefits. So as a member is actively working, we're maintaining a separate account for the member and keeping all that information together in the employer reserve account. So we do that. That's where your contributions go. That's where you're earning your investment incomes until the employee retires. And after the employee files for retirement, we calculate the benefit based on that employer's benefit calculation and determine what we believe is the present value of that retiree's benefits. So the amount of money we believe will pay this person, this member, over his or her entire retirement. So we do a one-time transfer from the employer account and the member account to what we call a benefit reserve account. So we do that one-time transfer based on the present value of the retirement payments over the lifetime of the retiree. And then we make all the individual payments out of what we call a benefit reserve account, which is pooled amongst all employers. Basically what that does from the standpoint of the plan operation is it takes the liability from that retiree outliving our assumptions off from the employer and puts it on the plan. So the plan sort of shares that liability. Well, for GASB 68 purposes, we had to decide what was appropriate, what appropriate method was to handle this pooled fund, because GASB 68 has separate requirements for agent plans and cost-sharing plans. But Bloggers really does not believe it to be a cost-sharing plan, so we had to basically, what we say, depool these, benefit payment funds in order to apply the GASB 68 agent plan guidelines. So I know this gets a little bit confusing, but basically what the actuaries are going to be doing is they will calculate the liability in total for these pooled funds. And while it's a pooled fund, we do know what retirees we're paying, which employers they belong to. So they will calculate a liability percentage for each employer. And then we will take that percentage and apply it to either right now the BRF is a little bit overfunded, so each employer basically is going to get their proportionate share of basically that asset that resides in the benefit reserve fund. So we will, basically, we will provide more notes and things like that into the accounting schedules and the documentation that we provide that kind of explains how Loggers is handling those pooled funds, because we are very unique in this respect. There's just a few plans in the U.S. that are like this. The Illinois Municipal Retirement Fund is very similar to Loggers. Their actuaries have determined that this is the best route for them to go to. But like I said, this is something that was very difficult for Loggers to work through in regards to GASB 68 and how to allocate those pooled funds. We approached GASB with this situation, asked them for guidance, and they essentially did not provide any. So we were kind of on our own with our auditors and our actuaries, and we do believe this is the best approach for the plan. As I mentioned, the Benefit Reserve Fund is a little bit overfunded right now. So we did have a mock group. We ran the accounting schedule for 4 or 5 of our employers, and it actually improved their conditions significantly because of the additional assets that they're getting from these pooled funds. So we were a little bit shocked, especially in some of our more mature groups that have, a large portion of retirees, that their GASB liability was considerably less than their funding liability because they're getting back a portion of those benefit reserve assets. So if anyone wants more detail on that, feel free to call the office or ask questions. I do know it is a little bit confusing, but we do think we found the best solution that works best for our employers with regards to us having aspects of a cost-sharing plan but still trying to apply the agent guidelines per the statement. So a couple things before we finish up that I don't have slides on that I do want to talk a little bit about. The first one is component units. Loggers is not aware of which of our employers report component units. I know there are some of you out there. We know that there are, but we aren't typically aware of who they are. So this is a case of a city who possibly has a library or maybe a museum who they consider, from Logger's standpoint, those library employees and those museum employees are considered general employees and Loggers of the cities, but they're reporting their own financial statements. So that would be what we would consider a component unit. Component units need to be handled more like cost sharing, but there's not a lot of guidance in the pronouncement on how to handle component units. So be sure you're thinking about that if you're in that situation, and talk to your auditors about the best way to approach this, because it's not information you'll be getting from loggers, because like I said, typically we're not aware of cases where you have component units. One of the other challenges for a lot of our employers is going to be participation in multiple plans. So basically any of our counties, because of your participation in SURF and loggers, you obviously are reporting on multiple plans. And to make it a little bit more complicated, SURF is cost sharing and loggers is an agent multiple plan, so you're going to be getting quite a bit different information from each of the plans, and probably even different measurement dates depending on what measurement date they chose. So, and you can also be in this, situation if you're a city who has your general employees and loggers, but you have your own police and fire plan or something of that nature. Or maybe you're still operating an old plan as well as having your new hires and loggers. Just make sure you work through this with your auditors. I believe some of the information can be reported together, like you can combine your liabilities and your deferred inflows and outflows, but you need to separate it out in the notes section. Again, there's not a lot of information that GASB provided on this. I have heard, just kind of through the grapevine, that GASB is not overly particular with what you do, as long as you kind of explain, if you've combined numbers, you've disclosed that, it combines the, participation in multiple plans. So make sure you've worked, through situations like that as well. Timing as far as when these documents are going to be provided, as I mentioned, the accounting schedules, which will have the bulk of your information. It will have your, the calculation of the net pension liability. It will include most of the information for your notes and for your RSI, except for the information that has to be determined based on fiscal year end. But so the bulk of the information comes from those accounting schedules that are prepared by the actuaries. So those will be, towards the end of October, possibly even early November this first year. I'm going to switch to a different screen here, so bear with me just for a second. This is a document that I've prepared that kind of explains what types of documents you'll be, receiving from loggers, what function they're used for, who's prepared them, sort of the as of date, whether it's the measurement date or the val date or the fiscal year end, the timing for which you'll be receiving them, and how you're going to receive it. This is also on our website. It's not included in the PDF of the slides, but it is a separate document on the website. But just to give you an indication of what you'll be expecting and when. As you can see, the delivery method on all of these is the employer web portal, or what we call EWP. I know you're used to the two-page GASB footnote page that you're getting for 27. Well, that is gone, and depending on how many different valuation groups you have, the accounting schedules is 60 plus pages. So that's not information we're going to be printing and sending to your auditors anymore. We're going to ask that you go pick it up from your employer web portal and provide it, to your auditors. I know a lot of you who are preparing the financial statements probably don't even know what the employer web portal is or have direct access to it. This is something you want to work out at each individual employer level. Typically, there are multiple contacts. You have an administrative contact, and then you have someone typically in your human resources department who's reporting wages and things like that. So work through each, of your organizations and figure out who has access to your employer web portal. Determine whether you're going to go through them or whether you yourself want to be set up for access through the employer web portal. Those are just kind of logistics that you might want to start working through as this information becomes available. We do send notices as we post information, but this typically goes to your administrative contact, and they or may not know what to do with this information. So make sure you're working within your organizations to access this information from your web portal, because again, that is the direction loggers is moving to as the method of providing this information. We can email everything on this list except your census data. We will not email census data because it is sensitive information. So if your auditor does want this information to come directly from us, we do understand that, and we'll email everything to them with the exception of the census data. The census data has been provided in two separate formats. It's in PDF form and Excel, so your auditors can do their sorting and manipulation in order to do the testing that they need to do. So again, as Jeff mentioned, the slides are on the website, so you can pick them up there. Just a little overview of what I intend to talk about in next week's webinar. Next week, I will show some sample information, show you an accounting schedule. We'll kind of walk through it so you can see specifically what information is provided there, show you a sample schedule of contributions. That contributions after the measurement date is a little bit odd too. I didn't mention that in this webinar. For those of you who don't have a June 30 fiscal year in, you'll have to incorporate an additional deferred outflow for any contributions you've submitted to loggers from June 30 to whatever your fiscal year end. So we'll provide that number as well. Might show you bits and pieces of the SOC 1 Type 2 report. Like I said, it's in progress right now because we're wrapping up testing. I'll show you a sample of the schedule of change in fiduciary net position as well. So those are the types of items that we'll go through on next week's webinar. So hopefully it can kind of, let you guys get a glimpse of what this documentation is going to look like. So with that, that is all I have today, and would be happy to answer any questions you might have.
All right, Melissa, we do have a couple of questions. The first one is from Amy, and she is asking, what are the requirements of GASB 68 to cash/modified cash basis?
All right, Amy, thanks. That's a tough one because I concentrate so much on the accrual basis. GASB does have the qualifications broke out based on your type of accounting, and I will tell you I'm not overly familiar with what the cash and the modified accrual basis requirements are. I will tell you loggers doesn't know who's cash and who's modified and who's full accrual, which is why all employers are going to be getting the GASB 68 assuming you're full accrual. So it's certainly something, if you need additional information in order to report your modified accrual or cash basis, you can contact the office and let us know, but you are going to be getting the full accrual. And I apologize, I can't provide a lot of information on the modified accrual. They are condensed notes from what I can tell, but I apologize. That's something, you can certainly call the office, or I can look into and maybe provide a little bit more detail at the start of next week's webinar too. I'll put that on my list to kind of talk a little bit about with next week's webinar.
Okay, great. We have one other question. This one is from Jill. How do the required note disclosures differ for employers using OCBOA?
All right, Jill, I apologize. I don't know the answer to that one either. I'm not overly familiar with the OCBOA requirements, so I will also add that to my list to do, and I'll address those at the beginning of next week's webinar. So there you go. It's a little enticement to make sure you sign up for next week's webinar as well.
Okay, great. Well, that looks like that is all the questions that we had. I want to thank everyone for taking time out of their busy day to attend this webinar. And as Melissa said, we will have another one a week from today at 2 o'clock. So we hope most of you can attend that one as well, where Melissa will go into a little bit more depth on GASB 68. You will be receiving a follow-up email to this webinar. So if you have any follow-up questions, you can just simply respond to that email and let us know, and we will try to get those answered. Thank you all, and have a wonderful afternoon.